So you're probably wondering who I am. I'm Emma White. I'm one of the partners at A4G. A4G stands for Accountants for Growth, because we like to work with owner managers who are keen to grow their business. But in terms of my career, I've worked in accountancy for 24 years, right from sole traders to startups through to high growth entrepreneurs. Where I spend most of my time at the moment is with growing businesses, helping them to just push those goals forward and hold them a bit accountable, really. So I'm currently helping 4 businesses to exit at the moment in various different ways. But actually the one that's most important to me is the one that's actually achieved the lowest sale price, which might surprise you as an accountant. But the reason being is I think they've actually got the highest value. They've got their life back. So if you imagine 2 business owners, one is really the driver. He's still generating over 50% of the sales, managing all the major customers. He had a bit of a turn for bad health, which was quite upsetting for his family. And I think both myself and his family were genuinely concerned that he might die before he retired. So we all sat down with his wife at that point, and I think really I just pointed out to them that actually they had got enough money to live the life they wanted to live without selling the business. So I know that's not necessarily, typical accountant stuff. It's a bit more practical, but I think that's quite critical when you're working with clients, is to really understand what their drivers are. So actually it all worked out really positively. We've sold the business. He's now enjoying time with his wife, daughter and granddaughter. But I think the most important thing for me was, to run a business, you should be getting more out of life. So wouldn't you agree? Fantastic. So I'm going to be joined up here this evening by my business partner, Malcolm Palmer, John Donnelly, who is a trusted financial advisor helping support A4G clients, and Charlie Clark from Foresight. And he'll be down later just to talk a bit about how he supports John with picking the right investments. And we couldn't have done today without our sponsors. We really appreciate all the support. They all work with growing businesses that are selling. So I'd like all of them to stand up. The sponsors, please. Give the room a wave, just to point yourselves out. And through the course of this evening, we're going to explain how they can also help with selling your business. So what will you learn today? We're hoping you'll learn about all your options to exit. If you're a Ronald and Elton, and that'll make more sense in a little bit, how to actually value your business properly, how to get the best deal you can, how to make the business less dependent on you so you can actually start enjoying yourself a little bit more, and what your next steps are. So can I ask everyone in the room to raise their hands, please? So for all of you, if you can't see this, this says you're a small business owner when that's your idea of work-life balance. Okay, so can you put your hands down if you didn't go away this summer? Okay, so there's a few of you that probably need to talk to us if you didn't give yourself a break this summer. Can you put your hands down if you worked during that holiday? Emails on your phone count. Right, okay, so we can see there's very few of you that achieved a summer holiday without working, so didn't get proper rest. So you're definitely in the right place this evening. So what type of business owner are you? I'm going to hand over to Malcolm now.
Thank you. So my first question is, are you a Ronald? Because there's 2 extremes of business owners here. So I just want you to imagine that this guy started off with his own little business, flipping burgers, and the business started to grow, and he started to be able to step back from the day-to-day running of the business. So the features of an Elton are, he has no contact with the customers anymore. He manages people and sets the direction for the business. He motivates and incentivizes the team. He develops new ideas. His business has got a good market share in the industry that he's in. And perhaps most importantly for everybody in the room, he's got a business that can be sold. And the reason he's got a business that can be sold is because it's no longer completely dependent upon him. Now, a lot of people aspire to be a Ronald, but there is another type of business person that can be almost equally successful, but is the other end of the extreme. So if you're not a Ronald, then you're probably an Elton. Because this guy here is one of the most successful people in financial terms. And the one thing he doesn't do is train up lots of little Elton Johns to go off around the country every single Saturday night performing Goodbye Yellow Brick Road. So at the other end of extreme to a Ronald business owner is an Elton. And the features of an Elton are Elton is the star performer, charges high prices. So if you're an Elton type business, you need to be in that top quartile price wise at least. The business is way too dependent on him to ever be sold. So he's got to invest his profits wisely. So just want you to just think about this, because the reality is probably nobody in this room is one or the other. We're somewhere on that scale. So maybe you're a bit more nearer the Ronald end of things, maybe a bit the Elton end of things, or maybe nicely in the middle. Maybe you're not positioned where you want to be. Maybe you need to be a bit nearer the Ronald end of the scale in order to be able to exit in the next few years. Anyway, if you are a bit of an Elton and the whole thing is dependent on you, then you better undertake what we call the Eltonification process. So let's have a little run through that. It doesn't involve wearing horrendous glittery garb, by the way. So the first thing you need to do, you've got to recruit great administrators, because you need to free up your time to do the stuff that earns the money so you can earn as much as possible. You've got to find people that can free up your time in whatever way possible. The real Elton, of course, will just have a massive entourage looking after absolutely everything for him. You've got to develop an awesome marketing machine to get bigger and better customers. I mean, nowadays that would involve social media presence of some kind. You want to become famous within your industry. You've got to perfect what you do, because you can't charge those high prices unless you are one of the best in your field. And probably you then need to increase your prices. So I'm going to hand back to my colleague now. He's going to talk a bit more about the Eltons of this world.
Okay, so if we assume you're an Elton, you get to the end of your professional career, you need to access that cash somehow. But you might find that you've got a lot of cash caught up in the trading business, along with maybe some investments. So it might be that as part of planning, a solvent liquidation is what has been decided is the best way for you to access that money. But you must do that within 3 years of trading. If you've got cash and assets in your business, you might want to get clearance from HMRC just to make sure you're going to get the most favourable tax rates on that. You need to employ a really good insolvency practitioner, which is why we brought Opus on as a sponsor. They're very efficient and make sure that everything goes through within, much earlier than that time window. We're never up against deadline. And the proceeds are treated as disposal of shares. So for any of you that know, if you're an owner, you're allowed £1 million in your lifetime that is taxed at 10% under business asset disposal relief, provided certain conditions are met. So that's why it's important to know if you qualify for that. So how can A4G help? We look with our clients about tax planning for company disposal, and we work with Opus on solvent liquidations. Then, as part of the process of obviously building a business, whether you're a Ronald or an Elton, you don't want your business value, and we hear this a lot, my business is my pension. It's like, right, what's the plan to access that then? And I think often that plan isn't put in place early enough, and obviously we've had, some downturns in the market with COVID. if you're wanting to retire and the market's not good, there's a problem there. So it's a really smart idea to also be building up an investment pot along that journey. So what do typical investment pots look like? Obviously, you've got savings accounts, shares, bonds, property, maybe personal property investment, and ISAs. That's in your individual name, but obviously you've put that money in out of post-tax profits. So you've suffered tax on that money before it's even been invested. So there might be a few of you in the room that have got investments in corporate entities in some ways. Anyone? Yeah, a few. Right. So there's multiple investment company structures, and I thought I'm just going to whiz you through some of them. And if you want to grab us at the end to talk about them in more detail, I'll explain. So holding companies, typically they own 100% of the shares of a trading company, and they might be put in place to safeguard assets. So sometimes the commercial property sits in there, high value equipment, and cash, to avoid cash being lost if there's a problem with the trading business. You might have a sister company that sits separately to the trade that money's been invested into for the purposes of investment. And whilst they're owned by two owners, they don't really interact with each other. One might loan the other money, but other than that, they're independent. You might have heard of a family investment company. Anyone? Right. So a family investment company typically was brought in for wealthy families where, you might have grandparents or parents put in a lump sum of money, and then they would have kind of controlling shares, and then you have multiple share classes under that for the children. Often because they don't trust the children to manage the investments, so they still get to make the investment choices, but they're just building that wealth for them in the future. But one of the things we've started helping clients set up are actually capital security companies. Now they're almost a bit of a hybrid between a holding company and a family investment company, because they might own a percentage of the trading shares to regularly move money for investment purposes and have the family involved in that company, but they're not shareholders of the main trade. But it then gives you some options there, and it can still be quite tidy for the purposes of sale. So the other thing we see is limited liability partnerships for property portfolios. Again, it tends to be family wealth planning, where you're investing in residential property, you want to pass it down to the next generations over time. And then pensions, by far the most tax efficient investment. So I'll hand you over to the expert, John.
Thanks very much. Cheers. So, hi, my name's John Donnelly. I'm a chartered independent financial advisor representing my firm, Donnelly Financial Advice. Donnelly Financial Advice exists to provide comprehensive and personalised financial advice to help individuals and businesses achieve their financial goals and secure their financial future. So today I'll talk to you about three aspects of planning which are tailored to be relevant to business owners. So we've got building your plan, focusing on minimising tax during the time you own your business, in retirement, how to have a sustainable retirement, and estate planning, ensuring you preserve what you have from the proceeds to benefit your family if you're no longer around. So entrepreneurs typically use their business structures to access income tax efficiently. Where corporation tax and dividend tax have been increased in recent years, this is ever more something that we need to think about to find tax efficiencies where possible, so that you get the benefit of being in business. For example, the typical way of arranging things, if you've got a limited company, is to take a low level of salary and the remainder in dividends to make the most of allowances and tax rates. For some reason, some business owners are under the impression that because their salaried income is under the personal allowance, it's not worth making further pension contributions, but that couldn't be further from the truth. If you're a business owner with a limited company, pensions are fantastic tools to extract money from your business in an unbelievably tax efficient way. Stick with me and I'll explain why. So I need to quickly cover something called the annual allowance so that you can understand how much you can put into a pension every year. So the annual allowance is the maximum you can pay into a pension in any one tax year. So it was 40,000 in 2022 and previously, and now it's 60,000 in 2023. So this is another area where some business owners get confused, believing themselves only to be able to contribute up to the maximum of their salary, which is often less than £12,570 per year, with the majority of their income being taken as dividends. This is not so where you're a director, where you can take the opportunity to make contributions as an employer from pre-tax company income rather than personal pension contributions. This means you're able to pay the full 60,000 into your pension, and if you've got carry forward annual allowance available from 3 previous tax years, you can put in 180k, and if you've got a spouse in the business with you, 360k, from pre-tax profits. So, but if you've not got that money, which some of us might not, but still got a fair lot, you can pay 100. In this example on the slide, you could, for example, pay 100,000, which uses up the current year's annual allowance and also uses up the allowance from 3 years ago, and then do it for 2 years more running. And then afterwards, you won't have any more annual allowance, so you'll be stuck with the 60k annually. But you'll have 300,000 in pre-tax company money in your own name in a pension. So it's well worth doing. So the final huge benefit of your pension is the inheritance tax benefits. Your pension provides a superb generational planning vehicle. An objective for the sale proceeds is to ensure that your family are looked after. So if you've diligently built up your pension over time, this pot can effectively become a trust for your beneficiaries, but without any of the administrative burden of a normal trust, and certainly the tax rates of a normal trust as well. So you could, for example, you could live off your sale proceeds whilst your pension passes entirely inheritance tax-free to beneficiaries. You won't be able to place significant sums into your pension post-sale, so it's something that needs to be achieved over time whilst you're growing your business. The question is not why you would contribute to your pension via the company, but why wouldn't you? Because the benefits are just that significant. So what else can be done with a pension from a director's perspective? Well, it's more esoteric, but quite common with directors, is to purchase a commercial property in the pension, and the rent and growth within that is tax-free. You can also borrow up to 50% of the underlying value of the pension to purchase a commercial property. And by the way, that doesn't count towards your annual allowance. So the rent goes in as an investment return. You can additionally contribute. And then less advisable in some cases, but sometimes useful, your own business, the sponsoring employer, can borrow from your pension. Okay. How to have a sustainable retirement. So you've worked hard to build your business and it's now time to maximise your future. Even if you're not considering retirement soon, having the right plan at all stages is crucial. And what I've found with my clients is that this is supported best with a visual representation using cash flow modelling, giving a coherent map to the targets that we agree. Any plan devised would be stress tested to gauge its sustainability using hypothetical market crashes, life events such as deaths, unfortunately, and alternative, sorry to be morbid, and alternative plans you are trying to assess and show clear routes to maximise the assets you have. So, ensuring that you preserve what you have from the business. So, estate planning. Okay, as a business owner, your financial plan should consider the future after the sale of your business. There are some major considerations for where the proceeds are invested after the sale to best serve the plans that you have. Where to put the money that you've built through selling the business, having a plan in place to ensure you have enough, and if you pass away, ensuring that HMRC are not the biggest beneficiary of your estate. In the UK, business owners can take several steps to protect themselves from inheritance tax after the sale of the business. Emma's spoken about some of them, I might add, but one effective strategy is to utilise business property relief investments, which provide substantial IHT relief either immediately if you've had a qualifying trading business or within 2 years if it wasn't. So if we compare that against trusts, which are 7 years, that's significantly quicker. Okay, so by ensuring that your business proceeds qualify for business property relief, owners can eliminate the possibility that those assets will be included in the calculation of inheritance tax. So if they died while retaining full control of those assets, okay. So additionally, implementing a well-structured estate plan, including trusts and gifting strategies, can further mitigate IHT. Taking independent financial advice is really helpful in navigating the intricacies of IHT and to create a tailored plan that aligns with your specific circumstances. So careful planning can help business owners preserve your wealth for future generations while minimising your IHT liability. Thank you very much for listening. I've got some branded up biscuits, but the main message that I'd like to leave you with is don't let HMRC take the biscuit and get your financial plan in place, all right? So there you go. Thanks.
So on our the second of our 5 ways that A4G, our sponsors, can help, finding the right investment vehicle, so the vehicle to hold investments within, what your investment strategy should be, inheritance tax planning, and tax efficient retirement planning. So now, the Eltons in the room, you can all relax a bit now. We're going to move on to the more Ronald end of the room. What if you're not an Elton? Well, your aim, if you're looking for financial freedom, is to make the business less dependent on you, which is, of course, is easier said than done. You can sit there and draw out a big chart of all the different roles that exist in the business, but the problem is that you're actually doing far too many of those roles within the business, and possibly beyond that bottom row as well, right down into the day-to-day parts of the business. Many business owners find that their big problem is that nobody else takes responsibility within the business. It all comes down to them. Had a lovely round of golf yesterday with 2 of my clients. One of them played really well for 3 holes, then took a phone call, swore very loudly and said something about why do we employ the stupidest people ever. Took about 6 or 7 holes until he'd sort of finally relaxed. And he said the annoying thing is, he said, I could have sorted out that problem in about 2 minutes if I'd been there. So never happens at A4G ever. So my amazing team at the back. The problem a lot of people have is that delegation is difficult. Everybody wants a mini-me to be able to delegate to, somebody that thinks exactly like them, so that when they delegate stuff, that person will know exactly what to do with it. But mini-me's rarely exist. If they do exist, they're out there in competition with you, right? So it's difficult to find staff that can work your way. Do we have any recruitment consultants in the room? Okay, close your ears now. We all know that in every industry there are a few bad pennies that go around the industry, don't we? Yeah, and you know, I'm sure none of them come your way, but one of my recruitment consultant clients said to me, he said the problem with our industry, Malcolm, is that there's a few bad pennies that just do the round from company to company. And I just went, Tom, that's in every industry. So you know, it is a challenge to find those people that can immediately land. And if you do want them in there, we do have 2 people here you can talk to. But of course, as a result, the business becomes totally dependent on you. So ways that you can make the business a bit less dependent on you. You can recruit technicians who are willing to learn, you know, potentially through apprenticeship type schemes. You can set up great systems. So, you know, there was actually 2 McDonald brothers that started the McDonald's business, and they were genuinely flipping burgers. And they put these great systems together, and this guy called Ray Kroc saw it, decided he could replicate it, and the rest is history. So get those systems right so that your knowledge is built into the process. Create some central data points so that when you're not around, people can find the right information about your customers, about their affairs. You know, does my head in if I'm talking to someone. It turns out that lots of company information is on people's C drive. That's disaster. You know, how can anybody access that when the person who uses that computer is not there? You need to incentivize and reward those key team members, potentially those who might take over the business from you in the future. The last thing you might think about doing is to recruit offshore. Now, that's pretty hard to do unless it's a desk-based job. But we have a little sister company. We think we found the best place to find non-UK staff, which is in Durban. So those of you that know your geography will know Durban is in Natal, which was the last bit of South Africa that the British were in charge of, and culturally well aligned to the UK, is how somebody put it. So the salaries there are about 50 to 60% of the UK, probably outside London. Rates. There's no employer's national insurance in South Africa. They've got an excellent education system. English is the first language. Well, it is for pretty much everybody that we will be employing out there. Very similar professional qualifications and experience. Their law starts from the same start point as ours does, so it's amazing. You know, we might be 150 years on, but we've still got very similar laws as a result. We've got very similar regulations as a result. The professions have very similar rules. We haven't found a qualification in the UK yet where there isn't an equivalent one in South Africa. Most significantly, there is 28% unemployment. Now, the staff in Durban that some of our clients have recruited, none of them were unemployed. But the impact of that unemployment level is that big chunks of the working population are doing jobs which are below their level of expertise and qualifications. So one of my team said, everyone's looking for a new job in South Africa. I said, well, not you, surely. Oh, no, not me, she said. So, but yeah, lots of people, you know, massively underpaid relative to their skill set. It's on a similar time zone to us. There's an hour difference in the summer, 2 hours in the winter. So staff out there can work to the UK hours and would be quite happy to do so. And the last thing, the great thing about Durban is that the accent is easy on the middle class ear, as one of my clients told me, whose best friend is married to a girl from Durban. So many of you, did you all get a phone call from Craig about reminding you about today's event? Yeah, okay. Did anybody notice Craig's accent? So, okay, yeah. So Craig is one of our support staff that works there. Brilliant. So just to quickly run through how it works. Contractual relationships. So we have a UK customer. They get invoiced by our UK company. The UK company pays our South African company. There's a bit of hedging going on with currencies, etc. And then the individuals are employed by that South African company. The employees are deemed to have two employers. So they've got the de facto one, the one that pays their wages and deducts their tax, etc., which is the South African company. But the real employer is the company in the UK. And that working relationship is purely between the individual in the UK, the individual in South Africa and the company in the UK, and we don't get in the way of that at all. So they follow your systems, your processes. We do a bit of, we call it light supervision, make sure people are turning up on time, not using their phones, following all the IT security protocols, etc. End result of all of those things that have gone through is the flow of work would improve, the number of checking procedures that you've got in your business can be reduced. I mean, I worked for a partner when I was training who had put checks in place to check that the checks for checking checks were being checked, and stuff still went wrong because nobody ever took responsibility. It was always somebody else's fault, should have been checked by somebody else. But you get those systems right, then you just eliminate the sort of things that can go wrong, and therefore you reduce the reliance on you. You also get a consistent level of service. So no matter who your customers are dealing with, they're being dealt with in the same way, which breeds confidence within the customers each time they call you. The end result for you, finding good staff becomes easier. It's good this time of year. We're in week 2, aren't we, of our new trainees? So love it the first day when our new 18-year-olds join. How many of my team were straight out of school? So yeah, and one straight out of university. So we've got those systems in place. It's easier to bring people into the business because of those systems. Efficiency will improve again because of that consistency, and your business will become more valuable. Now, there's a fantastic study out there that suggests that the same two businesses, the same two identical businesses with the same turnover, the same profit levels, the one that is fully systemized is worth on average 87% more than the one that is over-reliant on the business owner. So if you are thinking of selling in the next 5 years, that brings that into sharp focus. Less reliance on you, of course, so hopefully you can have more holidays and be able to sit back and maybe carry on owning that business long into what would otherwise be your retirement years and still getting that nice work-life balance. So the ways that A4G and our sponsors can help. For us, one of the things we do is a strategic planning day. So a strategic planning day, if you can get away from the business for a whole day, will begin with setting a timescale and saying, where do you want the business to be at that point, whether it's a year, 3 years, 5 years. Then asking, next question, where is the business now? So best answer I ever had was complete and utter bloody shambles, Malcolm. So, and then we started to get to the bottom of why. Once you've got that, then once we do those two things, we start to set some numbers. What sort of numbers do you need to hit to get from where you are now to where you want to be? Then we build an action plan. What are you going to do to get there? And then lastly, and perhaps most importantly, what are the things that's going to stop you? The other thing, we can help with the offshore recruitment. Anybody is interested in that side of things, give me a business card and we can organise a discovery session. But you can't go on forever. So what are the alternatives? I'll hand back to Emma.
Thanks. Right, I'm going to talk to you about the management buyout. So that's quite often an option that employers look for and how that works. So as you can imagine, there's many pros and cons of management buyouts, but I've picked a few of the key ones to touch on today. So I think the biggest one is the relationship with customers. The ownership can change without really sometimes the customers even being aware. You know, that their processes, the people they deal with, that all goes on regardless. You know, they're not having their client, you know, they've not got some new agreement page. They've not got to move over to a company that has totally different processes. And you know what it's like, none of us really like change that much. So that could unsettle clients and mean you lose a proportion of your business immediately. Whereas obviously that succession plan does mean you're more likely to retain the value of your customer base. Then obviously your buyers and their staff have got industry knowledge, and things are less likely to go wrong because they're not coming into it just from an investment point of view and not understanding the nuts and bolts of actually how you make money in that industry. So that's quite important. And then the seamless transition. You know, if you think about the processes and stuff like that, but you as a business owners have built, obviously your customers, those processes are going to maintain, and any changes are going to be over a period of time rather than everything change in terms of how they communicate with you, what you do in what order, all of that. So that can be, you know, a really big advantage for anyone. But there are some disadvantages. Obviously, if you're selling to a third party, you're likely to get more money up front. So if you're selling to a management team, particularly that are younger, you know, they might not be able to raise a lot of capital to give you initially. So it might be more of an earn-out deal. You're unlikely to get the best price necessarily, just because you might find a buyer who there's some synergies there between, you know, sort of merging two businesses. They only need one credit controller, they only need sort of one marketing department, but also you might have something that they can sell to their customer base, which to them adds a lot of value. There's always the risk of what if it doesn't work? with the management buyout, then the asset that was your big asset that you've worked all your life to build might have been deteriorated over time. And then obviously sometimes it can take a little while to get those deals over the line because no one wants to say exactly what they're thinking to the other partner, because you've all got to work together still until a deal's actually done. So sometimes that can just make it a little bit harder. So how are these type of deals typically structured? So for a sale of shares, you'd have the owner currently, and you've got the existing company. So then you'd have the management team. They'd set up a new company to buy the existing company. So they'd buy the shares from the previous owner in the new co. So that's where the debt sits for anything that isn't paid up front. Then dividends are paid from the existing company up to the new company, and money is paid down to the old owner. So that then works itself out over time. So has anyone heard of an earn-out via an LLP? Do you know what I mean by an LLP, a limited liability partnership? Okay, excellent. So with an earn-out via an LLP, you'd have an existing company, and then the buyers would set up a new LLP. Then you'd come to an arrangement about sort of a monthly franchise license fee that is paid across to the existing company for use of branding, client base, processes, and things like that. So that would go across on a monthly basis. And you might have a final balloon payment or a nominal payment at the end just to cease the deal. Now with that monthly payment, that you might want to share some of the risk with that. Obviously where you're leaving yourself quite exposed to payments from the existing trade, it might be that there's a profit share element built in there. But actually in these situations, a sale of shares, the tax is obviously all paid up front. With an LLP, it's kind of tax neutral because the new owners are getting tax relief on the monthly payment and the seller is paying tax as they're receiving the money. The seller can end up slightly worse off, so you'd build that into the deal because they wouldn't be doing a sale under business property relief. But, that's all part of what we negotiate, isn't it? But the reason we like LLPs is the flexibility. Because the amount of times we speak to business owners who are 50-50 or third, who actually are a little bit annoyed at each other after working together for so long. The things have started to grate just because there's always one person that seems to be driving the ship a little bit harder. So the reason we like LLPs is because the profit share element can be sort of sectioned up into different parts. So the job roles and the responsibilities can be paid a bit like salary, but down as profit share to those individuals. And then maybe the equity, the remaining profit, is split equally or based on whatever people have brought to the party. Now, the reason we like that is because it doesn't have to stay like that forever. If you're prepared to have adult conversations and talk to each other about the things that aren't quite right or the responsibilities that need to change, that can change throughout business life. And I think we all know it's very hard to, all be doing the same thing and putting in the same effort throughout the period of a business. So the other alternative you see is an employee ownership trust. And if you imagine John Lewis, it's where all employees are part of it and everyone benefits in some ways. So this is typically seen sometimes when a third party sale hasn't been achieved, but obviously the current owner does want to be able to exit the day-to-day. So the advantages of an employee ownership trust are obviously, for any of you in the room, if you don't achieve a third party sale, you can still realise the value built up in the business. There's leadership succession, which is quite important. You do get to leave it to the people that you've trained. You've got the peace of mind that at least you know the people taking over. And there's a legacy issue. That might be your work family that you've built over decades. But I think if you imagine you spent your life building a business, it employs a big chunk of the amount of people that live in your town or village. You sell it to a third party. They close that operation down. They move it out of town. They make half the village redundant. Well, you're going to go for a pint on a Friday. You know, you're going to have to do your shopping in disguise. So that can sometimes be some of the reasons for these things. And another advantage is that there's no capital gains tax on the sale for the seller. So, but obviously it's an advantage sometimes that all employees are involved in some way. But as much as I'm saying it's an advantage, it can sometimes be a disadvantage that all employees are involved in some way. There's also a cost element to set it up. You know, it is intricate. And again, you know, you're unlikely to get the uplift on the sale price. And again, you know, there's no promise of it being successful. So how can A4G and our sponsors help? Obviously, we can give advice, and we do this quite a bit on different types of management buyouts. I think the more important part is we can be an independent third party in the negotiations with management, which just avoids hurt feelings. And then we work with Postlethwaite on, where's David?
We're scanning the
yeah, I was going to say, where's David? There's David. Yeah. And we work with David on getting those set up correctly and running well. Thanks, David. So, what if there isn't anyone capable of taking over?
Okay. So, quick show of hands. How many of you think that your exit route for your business will be a sale to a third party? Good. Okay, right. I'm going to attempt to frighten the crap out of them now. Okay, so let's just go through the process of a sale to a third party. The first thing that you've got to do is find a buyer. Most sales, believe it or not, are to somebody that the business owner knows. That could be a customer who's looking for a bit of vertical integration, a supplier, or perhaps more likely a competitor. I think if you ever get a phone call from a younger competitor who says to you, would you like to have a meet for a coffee sometime? That's code for, are you interested in selling your business? So you might not even like coffee, but go. So that's the first type of buyer. The next type of buyer could be somebody we know. You know, if we're your accountants, we know a lot of people. We know the good ones and the not so good ones, the ones that might be a nice fit business-wise. So have a chat with us. But perhaps more likely, if you don't find a buyer through those routes, will be to go through a specialist broker. Now I put specialist in there because I think in a lot of industries that is quite important. You know, some of the brokers can earn some really good fees out of this, but for what you might consider to be relatively little work, but actually the work has been done over 25, 30 years, building up all those names and phone numbers in their little black book. You know, they'll know the players in the industry, they'll know what's going on, they'll know who's buying, and they can be a really good connection between you and that potential buyer. So the second stage is the negotiations. So, you know, these always start off quite well. You know, the price always seems to be agreed fairly quickly, but it's further on in the negotiations when you start to get down to the fine detail where things can fall down. I've spent a lot of time in the last 4 or 5 months dealing with 2 sales of owner-managed businesses, completely different industries, very similar in size and profit level. One got over the line, the other one fell down about 4 days before the agreement was going to be signed. Just little arguments about some of the detail, and my client said, do you know what, I just don't want this, and walked away from it. A big element of the area for dispute is often deferred consideration. So, you know, what the buyer wants is to give you as little as possible up front and to defer the rest of the money as long as they possibly can. What you want is to get everything up front on day one so you can walk away, there's no risk. And that's where a lot of the negotiation needs to take place. You know, there can be sometimes there are conditional elements to the consideration based on the profits in the next 2-3 years or whatever. Sometimes you might find yourself working harder for 2 years after selling the business than you worked beforehand. There will often be a lock-in of directors. So, you know, what we've got at the moment, do you have any vets or dentists in the room? The last 4 or 5 years, you know, do we have any people that have pets? So yeah, do anyone who's got teeth? Yeah, okay. So you'll have noticed that those prices have gone up a lot in the last 5-6 years. A lot of that is because there is lots of foreign money put into investment funds, given to small little private equity businesses who often don't have more than 6 or 7 people in them, who are then looking to consolidate lots of small businesses in an industry in order to make one big business and then sell out for a much higher multiple in 5 years' time. That tends to be the standard deal. And what they want to do is they want to lock in the directors for as long as they possibly can so that they don't actually have to do anything running this business themselves. Some industries that's been more successful than others. There's likely to be some kind of restrictions on there. You know, if you're in your 70s, he says, trying not to make eye contact with anybody. You're probably not going to be worried about restriction of trade. If you're thinking of going and doing something else, then you might have thought to yourself, well, if that doesn't work out, I can always come back. But, you know, be careful what the sale agreement says. There will, I think I've already said this, or maybe some conditional elements to that deal that are based on future profits. So that's the second part of it. The third part is the legal process. So this is where it gets really painful. So the first thing, you're likely to find yourself with an 80-page SPA, Sales and Purchase Agreement. Where's James? So James, do you want to stand up? 80 pages, is that about right?
Yeah, if you're lucky.
Yeah.
It can be a lot more. So yeah, 80 pages fairly reasonable.
Yeah.
Some light reading.
Some light reading, yeah, absolutely. And you know, and that goes forward, can go back and forth quite a lot, really, can't it? So there may be some there will be some warranties in there. There will be tax warranties in there. You will be signing your life away to all sorts of things that you know are never going to come up, and a few things that you would never have thought are going to come up, but could do. So any of these things in the warranties that come up in the next however many years that were there the day you signed, you're going to be paying that money back, or it's going to be coming off the deferred consideration. This can take many months to get through. Many hours of your time could prove to be a big distraction from doing what you need to do on a day-to-day basis. As a result, it can be quite difficult keeping it quiet. So the best example of this I've ever had, one of my clients, this went on for about 5 months, and he ran this like an MI5 operation. So there was, you know, the whole thing had its own project name. Everything was completely secret. Virtually everybody at A4G was warned never give even a hint that anything's going on. And he was working late one night, and his cleaner said to him, "Oh, here, you're selling the business." So everybody in the company knew that he was selling the business. But his cleaner, was the only person that didn't know that it was a secret. So he doesn't know how it got out. Maybe he walked away from his desk one day with an email open on the screen, but everybody knew, they just hadn't told him. The other thing is that during that process, sometimes there can be a little bit of buyer's remorse, particularly if there's some big organisations at the other end. Who knows what's going to happen out there? Who knows which country is going to invade which other country, what that might do to the borrowing market or that company's circumstances. People can back away for all sorts of reasons that are nothing to do with you, but are just to do with them. Sometimes you get the seller's remorse as well, that along the way you actually think, hang on, do I really want to actually do this? Do I actually want my business to be sold to some people that I don't particularly like? So there's a lot of reasons why a deal can fall down. In honour of my client who did get their deal over the line, you may suffer a bit of deal fatigue along the way, where by the time you sign, you think you're like pop open a bottle of champagne, but you just want to flop into bed and go, thank God that is all over. Of course, during that time, there can be a drop in performance of the business, which, if there's a conditional element to this, can become a problem. A big distraction like that for the business owner will have an impact. So the last part is the aftermath, after it's all done. There can be interpretation of key terms. We all thought we knew what clause 17.3.7 meant, but actually now we come to read it, the buyer thinks it means something slightly different to what we thought. There can be difficulties working together. How many of you have been running your own business for more than 20 years? Yeah, you are all completely unemployable. So you're just too stuck in your own ways too. And I held my own hand up advisedly. So, that can be really difficult doing that. It can be a loss of direction after the business has been sold. Or alternatively, maybe you've got a bit tired and maybe it might go the other way. Maybe there'll be a renewed direction and drive, and the business might start to fulfill some potential that it's been missing out on. But of course, the most important thing you want to know of all is how much money will you actually end up with. So I'll hand this back to my partner.
Sorry, I'm not trying to cause suspense there. Right, okay, so there's multiple different valuation methods, but the most typical that we see are EBITDA, which is the most normal method. That stands for earnings before interest, tax, depreciation and amortisation. But there is a point where that's not appropriate. So they might use EBIT. Now, for a good example of that is for a transport company. Big haulage company, to take out depreciation, the reduction in value on the vehicles would make the valuation just nonsense, especially if you compared it to a company that are leasing theirs. So that might be a situation where EBIT's used, and EBIT is earnings before interest and tax. So how does that work through? So adjusted EBIT or EBITDA, and I'm going to explain what I mean by adjusted in a minute. It's times by a multiple. Typical multiples we see are between 4 and 8, but depending on certain industries, they are, sort of tech, maybe financial services, they might, achieve like 10 and above multiples. Then we'd add in surplus cash and commercial property. So if you look at your accounts, you've got profit after tax, say 750,000. We'll take the average multiple of 6, £4.5 million. Excellent, you all know the value of your business, yeah? Not quite. So we then add back in the things that aren't relevant. So we've got finance costs, sort of bit of interest, bank charges, they might go away with sale. You've got depreciation and amortisation, and you might have had one-off item in that year that you're using, or in the previous years where you've moved business premises and you've spent a lot of money on refurb, or you've had a bad debt, and using that number would just be unrealistic to what they're going to achieve. So we'd put those back into profit. And then we take out the things like interest income, grants. So we've seen quite a lot of businesses trying to use the COVID grants as part of valuation. That's not fair. And profits on sale. So actually that uplifts the profit on your accounts. But most important of all are actually the market value adjustments. And typically we see a lot of businesses who might look at their management accounts or annual accounts and go, oh, wonderful, like we're doing really well. And not necessarily appreciate that their accountant has put them into a tax efficient arrangement where they're on small salary and dividends. So dividends come off separately on the account. So your profit is inflated because it doesn't include the money you're drawing. So when we look at the add backs, we'd add back into profit the small salaries, pension contributions, maybe if you're employing family members, we'd take those things out. or if you think you're driving a particularly nice car that wouldn't really be in there under normal circumstances, we'd add those back into profit, and then we deduct market value salaries for the roles that need replacing to get you out of the business. Now that's not just your main role. Well, you tend to lead the marketing campaigns. You deal with the tricky HR disputes. You know, it's all those little bits that you touch that someone else is going to need to pay either a third party or employ to replace. And then obviously if you've got a commercial property in there, you're not paying rent. So you'd have to deduct a market value rent for your business. And as you can see, that has quite a significant impact on your valuation. That would reduce your valuation by nearly £1 million. And most business owners don't know those numbers, which makes it hard to then focus on what drives value in your business. So if we take the true EBIT and then we add the spare cash and the commercial property, we're back up to nearly 5 million. But then we've got to take off the costs of sale. So we take off the broker's fees, which are typically around 4%, legals, accountancy, and then you've got what is your taxable proceeds. So as I mentioned earlier, so say this business has 2 owners and you both qualify for business asset disposal relief. So you get your first £1 million at 10% and then the rest of it is at 20% based on sale of shares. So you deduct your tax off that and you end up with just under £4 million. Now, we always look at these numbers before any offers are accepted, because actually if you're not happy with that number, it's no deal, isn't it? So, you know, if you are happy with that, happy days. Most people have half spent that in their head before the ink's dry, but that actually creates a tax problem, because at the point it's in your business and you're an owner, you're covered by business property relief and it's 100% IHT free. The minute it's cash in your bank account, that's cash in your estate. So I'm going to hand you over to Charlie now to talk about some of the things that you can do after that. So it is a tax problem, but it's a wonderful one to have.
Thank you very much. Thank you. Good afternoon all. Hopefully you can all hear me. So what I'm going to talk to you today is about tax planning opportunities as business owners. Before I do, who am I? My name is Charlie. I work for Foresight, whose offices you're in today. We are an infrastructure and private equity investment manager. I've been working in this space for about 11 years, and the last 5 has been very much focused around these types of planning scenarios. Now, I'm conscious I've only got 7 minutes to try and teach you about something that normally takes me about 2 hours. So I'll go through it as quickly as I possibly can. A bit of audience participation very quickly. Who here has heard of a venture capital trust or VCT? Okay. Who here has heard about, before this, business property relief or business relief? Okay, fine. Well, there's a little bit of education in there, but I won't spend too much time. There are risk warnings. There are 3 risk warnings. Just to be clear, I'm not a financial advisor. I'm not a tax advisor. I'm here to provide distribution on Foresight's investment products. That is all I'm here to do. There are people around the room that can help you with that sort of thing. Foresight, as I mentioned, is a private equity and infrastructure investment manager. We've been doing it since 1984. And the first product I'm going to talk to you about, the first solution, is venture capital trusts. So a venture capital trust, introduced in the mid-90s, is a way of incentivizing investment into UK PLC. It provides you with 30% income tax relief, tax-free dividends and tax-free growth. It is considered a high-risk investment because you're investing into small UK businesses. Some of your companies in the room might have benefited from venture capital trust funding. The particular sort of case study that we're going to talk about is you holding excess cash on your balance sheet as a business owner. Now, for various reasons, that might not be a good thing. Clearly, it's cash, maybe not in the current environment. Normally, you wouldn't be earning a lot of interest on that cash. It's not working capital. It could also affect your business's ability to qualify for business asset disposal relief, or formerly entrepreneurs relief, but also could affect your business's ability to qualify for business property relief, i.e. if you were to die owning shares in your business, your beneficiaries wouldn't be able to inherit those shares tax-free. So holding too much cash on your balance sheet might not be a good thing, a most tax-efficient solution. Now, one of the things that's often holding people back from extracting that capital from their business is the income tax that creates. So here is a very brief kind of scenario, bit of synopsis of what that would look like if you were to take 50,000 from your business as a dividend, and the effective tax rate based on allowances, certain assumptions made here, would be 33%. Now, as I'm sure you're all aware of this, but these are the higher rate dividend tax allowances. So what we're actually talking about here is a way of extracting your capital from your business, 50,000 for example, and using that capital to create some opportunities, but also some tax planning opportunities. So as I mentioned to you earlier, 50,000 taken out of a business, 33% effective tax rate. If that's cash going to your bank account, you've paid £16,500 in tax, you're left with 34,000. What you could look to do, we've covered that. What you could look to do is invest into a venture capital trust. A venture capital trust, as I mentioned, provides you with 30% income tax relief. It is a 5-year hold, so you've got to hold the investment for 5 years. If you sell it prematurely, you have to repay that income tax relief. But the main objective of a VCT is to provide you with tax-free dividends along the way. Typically speaking, those dividends are targeted at about 5% in the market. So this here is trying to illustrate what that could look like for you. So that 50,000 has come out of your business. It's cost you 33% an effective tax rate. You've reinvested those proceeds and a little bit of cash on your personal bank account into a VCT and reclaimed £15,000 of income tax relief offsetable against your income tax bill. So that the effective tax charge in that situation is only 3%. You remain invested for 5 years, as is the whole period, and hopefully your VCT achieves its target, and that is a stable share price, i.e. your share price is still worth exactly the same as when you left it, but along the way you've had 5% tax-free dividends. A 5% tax-free dividend in the real world is probably equivalent to about 8.5–9% if you are a higher rate taxpayer. And then after the 5 years, you then come to sell your VCT, and if you use this illustration of kind of not including costs and charges, you're looking at potentially a 55% return. Now, unless there were some very exciting, what we call special dividends, the likelihood is that number would actually be slightly less because of costs and charges, but hopefully you can see what this is trying to illustrate here. 5% every year, plus your 30% income tax relief upfront. I'm not going to spend too much time on this, but as I mentioned, you need to sell the VCT at some point. You don't have to, but you can. If you want to continue benefiting from tax-free dividends, by all means, continue to hold it. But what you can choose to do after 5 years is sell the VCT. What I was kind of stressing for this slide, what my colleague who was meant to be presenting here today was stressing on this side, is that if any of you were to make an investment into VCT and look at the value of your VCT by searching in Foresight VCT, probably the top result will be Hargreaves Lansdown, and you'll look at that and it will show you what's called the share price. That is not an accurate representation of your personal holding. What your personal holding should be and what you should be looking at is what's called the NAV, the net asset value. That is more of a reflection of your position. The reason I tell you that is that sometimes we'll get contact or people will call us and say, I'm looking at this, it looks like it's sold. It looks like it's down 30%, down 20%. They are what's called secondary market shares. If you were to go and sell your VCT yourself through a Hargreaves Lansdown or through some sort of broker, the likelihood is it would cost you 20% because you'd be selling at the share price, not at the net asset value. The point I'm trying to labour here is be in contact with the firm that's distributed your VCT because it could save you a bit of money. That's the reason we have to include that slide. Where the planning gets particularly interesting and particularly exciting is that you can continue to recycle money every 5 years. So you can do a VCT up to an allowance of 200,000 a year, getting 60,000 of income tax relief. Using the example earlier, you've invested into a VCT in year 1. You've then extracted the capital and done it again in year 2 through to year 5. So you've done a VCT every year for 5 years. In year 6, your year 1 VCT has now matured. So you can extract that capital and put it into your bank account. But what you can also do, if you wanted to, and where this becomes really exciting, is you can take that £50,000 out of your business now, that's sat as excess cash on the balance sheet, because you have a maturing VCT over here that you can roll and get another 30% income tax relief, that 50,000 that you've taken out of your business, you can now put straight in your back pocket. So you've managed to extract business from your capital from your business. Yes, it's taking you 5 years to do it, as well as tax efficiently as possible. But come year 6, year 7, year 8, you're now taking that cash from your business and putting it straight into your pocket because you've got this chain of maturing VCTs that are building up. And if you continue to do this, as it mentions here, year 5, year 10, year 15, you can get yourself to a situation where you have a reasonably sizable, hopefully, VCT pot that is paying you out tax-free dividends that you can supplement with your pension income, or if you don't have a pension, as a form of pension income. Whistle stop tour, usually do that in an hour. Does that make some sense? What we haven't spoken about here is specific products. We've spoken about a strategy, a form of tax planning. Speak to a financial advisor for more information. Right, that's that bit done. Okay, so that's during your business. Now we're talking about something after the business, i.e. after you've sold your business and you've been given a valuation. So this looks at a case study for someone who sold their business for £3 million. As I mentioned to you earlier, most, or as has probably been mentioned, most privately owned businesses, if you are a trading business and do not have too much cash on your balance sheet, should qualify for business property relief or business relief. What that means is if you die owning your business, your shares get passed on to your beneficiaries with no IHT to pay. However, you're 50, you're 60, whatever it might be, you decide to stop working and you decide to sell your business. So you now have cash in your bank account. If you were to die with that cash in the bank account, you are paying 40%, or your estate will be paying 40% to the taxman, to a stranger you've never met. This particular case study looks at a person who sold their business for £3 million. After repaying all their debts and anything else they want to spend their money on, they're left with £1 million of cash in their pocket. Business property relief was introduced in 1976, and it was an incentive to pass on businesses through the generations. The terms of business property relief say you need to hold the shares for 2 of the last 5 years and still be holding those assets on death. In this situation, that £1 million in your bank account is subject to 40% IHT, forgetting kind of nil rate bands and what have you, assuming that's been used up by your property. Under the terms of replacement property provision, i.e. the 2 of the last 5 years piece that I just mentioned, you could reinvest those proceeds into a business relief qualifying investment, of which Foresight is a provider of one and there are numerous others, and you would get immediate qualification for business property relief. I.e. you could die a day later and your entire portfolio, or that entire £1 million portfolio, will be passed on to your beneficiaries with no HT to pay. Again, that was quite quick. Hopefully I've done it within 7 minutes. Like I say, these are just 2 forms of planning with VCTs and business property relief. There are people around the room that I'm sure could answer more questions. I'll hang around for a little bit as well. But hopefully it just gives you some of the ideas of kind of tax efficient solutions that you could consider for your business, whether now or in a few years' time when you come to sell. Helpful? Good, I hope. Okay, thank you very much. That's me.
Okay, so how can we help? We work with a lot of clients on looking at the strategic sale plan well in advance of the when I want to retire question being thrown at us, don't we? But with a lot of our growing businesses, we'll actually do regular business valuations, just as a sense check for, are we on track? Is this the goal? What do we want? Oh, how close are we? We'll work on maximising the sale price. And I think the most important bit, as Malcolm said, a legal agreement, 80 pages long. We actually do the financial modelling of what that actually means in cash terms, when tax is paid, all of that. So when the cash will be coming and the tax deadlines and things, just so you know what you've got available when. And we can act as an intermediary between the buyer and seller, which I think sometimes is quite handy. You get like a professional's opinion on whether you think the buyer is actually capable of taking on this business and running it well enough to pay you what you've agreed. And actually, that was the conversation we had on the way up here, wasn't it? I was like, I've got to tell one of my clients that one of their buyers, and certainly, the other people involved, I just don't think they'll get their money. So that'll be a no decision from me unless there's a number of changes. But luckily, they've got a lot of interested parties. So Certainly at A4G, we have set aside some 30-minute consultation slots with our principal advisors, many of whom are in the room over the coming months. So if you did want to have a chat about your business, do make sure you speak to the guys at Gemma and Reese that booked you in. They were downstairs on the desk. They will take that information for you. And I know John will certainly welcome any conversations along with our sponsors. So you've got everyone's contact details there. Thank you all so much for being here and for your time this evening. We really do appreciate it. We have got wine and beer and sweet treats and sandwiches at the back of the room. So we really welcome you to stay, talk to us. It doesn't have to be about your business. I'm more than happy to talk about what you have for lunch. But do stay and enjoy yourselves a bit. So thanks again.
I'd also like to say thank you very much to everyone. Oh, sorry.
Sorry, no, it's all right. I was like, do you need it? No, you don't.
Thanks. Yeah.